Hi, I'm Sean with Ledger Ready, and today is episode 3 of What is Accounting and How Do I Do It? Today I'm just going to run through a quick example of the difference between profit and cash flow. And if you missed my first two episodes, the first one on the balance sheet, second one explaining the income statement, I touched on this a little bit, but I wanted to hammer the point home today. It's something that is a very important concept to understand as a small business owner. And as I go through this, I encourage you to recreate this example yourself with your own numbers in the context of your business. I always find that for myself, it helps me to think of what it is that I don't know. You know, the types of questions that you might not always think of when something's being explained to you. But when you go to do it to yourself, you realize, oh, I have this question about this piece of it. So if you have any questions as you're going through, please come back and put them in the comments. I respond to every single one. So this is the example that I put together, and don't worry about all these numbers here. I'm going to explain every piece. I called this Sean's Bikes. I don't know what a bike costs these days, but Sean's Bikes is selling bikes for 250 bucks. They cost me 100 bucks to make. I put this little tidbit down here. I don't think I'm actually calculating this right here though, so I'm gonna do this. I'm gonna change my formula up a little bit here. So there we go. This is how much I have left at the end of every month. All right. So anyway, this is my activity. Let's ignore that for now. We're gonna start with April. So April 30th is our starting point, and so we have my bicycle business has $10,000 in cash, $40,000 in inventory. I just started, I funded the business, I bought some bikes. I'm ready to get to work here. So I'm going to scoot over here. Here's my income statement. So first month in business is May, and hey, pretty solid month. Sold 100 bikes. That's what this formula is doing. It's just doing 100 times the price of my bike. So 25 grand in revenue. Cost of goods sold, that's what the bikes cost me. And so, I have some outside manufacturer make them for me. I sold 100 bikes, and it cost me 100 bucks, so 10,000. That brings you to gross profit. So that's my direct profit from the sale of bikes. Revenue minus the cost of the bikes. All right, then we get to the overhead type stuff. So also referred to as selling, general, and administrative, or SG&A for short. Here I have salaries and benefits, salaries and wages, sometimes what it's called. You can set it up however you want if you want to break it out. But here I'm just, I just put a pretty simple formula in here. I assumed 40-hour work weeks, 4 weeks. Maybe I have one employee that I pay 30 bucks an hour. And, so that's, numbers don't really matter. I'm just trying to demonstrate this here. So utilities, you could call this, if you want, rent utilities or something like that. It's just to say I rent my storefront, and utilities are included in my rent, and I'm paying 2,000 bucks a month. I did the same for both months because it's flat. That gets me total expenses 6,800 bucks. And then it's just simple arithmetic. I'm just doing gross profit minus total expenses, and that tells me what my profit was. Now, let's assume I didn't collect any cash from the customer in May. I just said, "Hey, you owe me. I'll invoice you." So every customer, none of my customers paid with cash, and I'm just going to invoice them. I didn't buy any more inventory. I already had enough. And then salaries and benefits. Let's just say I ran payroll. I run payroll on the first of the month. So I would have run payroll on June 1st. And when I say run payroll, I mean actually printing checks. So I had this is how much my employee worked. this is what they earned in May, but I didn't actually pay anything in May. So I owe them $4,800, but I haven't paid them yet at the end of May. And same with rent and utilities. You typically get a bill for that. You might pay most people I think pay on the first of every month with that as well. So let's just assume that's the case. So at May 31st, I made some sales, 25 grand. So that's what's coming in here. My customers, this is an add to accounts receivable showing my customers owe me 25 grand now. I used up, I had $10,000 in cost of goods sold. That's the value of the inventory that I sold. So now my inventory is reduced by that. And then I have this payroll accrual. That's just a fancy way of saying I owe my employees now because they had some hours. I owe them for those hours, but I haven't paid them yet. So that's see how this all equals here. So 4,800 is that was what my salaries and benefits expense was for May. Accounts payable is bills to vendors, and so my only vendor in this case is my landlord for $2,000. I haven't paid them yet. So guess what? My net cash flow for May, $0. I did not pay any cash to anybody, and I did not receive any cash from anybody. Now we're going to go to June. Same exact situation. The numbers are a little different, but the mechanics are exactly the same. Let's say I doubled my sales. I'm killing it. My customers love my bikes. They're giving me some reviews. Naturally, my cost of goods sold doubles because I sold twice as many bikes. So that, again, gross profit. Now I had to hire another employee because, business is booming. Let's go. So I hired another employee, paid them the same amount. My salaries and benefits doubled. Now, same with utilities remain flat. So now I have more profit. Yes. So in total profit for my 2 months, I have 26,600. Now let's just say, for argument's sake, that I'm not good at collecting from my customers. I haven't been able to get anything from them, and as a result, I can't pay my employees or my bills, so I'm delinquent. So not a great situation cash flow wise. But what does that mean? It means I have zero cash flow. I have no cash activity yet. Nothing's happened, and yet I have $26,600 in profit. That seems good. It sounds good, but I don't have any. My bank account hasn't changed. So let's switch this around a bit. Let's say in June, I collect my prior month's accounts receivable. So I get $25,000 of cash. In my receivable, this is the addition from June over here, the sales for June. But let's say I collected my May sales. So I collected my May sales. More cash, less receivable. Let's say, so inventory, I already paid for that. That doesn't impact cash at all unless you add to it. But I didn't have to buy any more inventory. I still, I should probably buy some more soon because I had, those sales. I had enough sales, so I'm probably gonna run out of inventory if I don't buy any. But then let's go over here. Let's say I paid these on the first of the month when they were due. So my May expenses were $6,800. June's not due yet until July 1st. So in June, on June 1st, I paid that $4,800, and I paid that accounts payable. And what's that do? That's going to subtract because I paid it out of cash. So now I'm going to have to, do that. So what's that do? Nope, this formula is not doing any good. So again, I had, this is my profit. I sold 50 grand in bikes in June. Total sales 75 grand. Sounds so good. But I didn't collect it all, because I'm kind. I don't force my customers to pay me at point of sale. Probably should, but didn't. And as a result, because I'm letting my customers pay later, I'm not collecting. My cash balance isn't going to go up as fast. It's not going to reflect my sales right away. So over time, if your sales stayed steady, all this stuff stayed steady, and you didn't change your payment terms for your customers, and your vendors didn't change terms, eventually your this cash activity would mirror your profit. But because of this delay and the change in my sales, I have this big, this nice gross profit change here, but I only have this change in cash of $18,200. So pretty good, but that's the reason for the difference here. And so, that's important to understand. And you wouldn't, without doing this accrual accounting method, you wouldn't get a good you wouldn't get a good estimate of, or a good marker or idea of, I'm not sure what the right word is here, but you wouldn't know, I guess, what your net income is, what your profit is, if you didn't do it that way. If you were just cash basis, it would be hard to analyze how well your business did month over month. So using just a straight cash method where you only record transactions when it's cash out or cash in, I don't like that, because then it's hard to say, like, am I getting better? Did my sales improve, or did I just get better at collecting? So understanding the difference in these, very important. So that concludes my profit versus cash flow example for today. If you have any questions at all, or other topics, or that you'd like me to get to, anything at all, just please comment. I respond to them all. And also, we have an email newsletter that we started. Again, Ledger Ready is the name of the company. You can find our newsletter at ledgerready.work. And I just do a weekly newsletter where I send out accounting tips that might be helpful to you. And we're also working on accounting resources for small businesses to walk you through how to do this from the ground up. So building your accounting process, and also understanding your business finances. And so that's something we have in development now. So if you subscribe to that newsletter, you can get regular updates on that. And eventually, we plan to offer discounts for our newsletter subscribers once that product's ready to be released. Okay, that's all for today. See you next time.